Blocks Proprietary Limited manufactures building blocks and sells these to retailers. Blocks suffered a tax loss in year 1 and needed additional capital, so at the start of year 2 it issued ordinary shares to a new investor. Blocks subsequently had a profitable year, conducting its business as normal. To recoup the tax losses from year 1, Blocks needs to meet certain tests. The continuity of ownership test is not satisfied because the same persons from the start of year 1 no longer own the same shares representing more than 50% of relevant rights at the end of year 2. However, the same business test is satisfied because Blocks is carrying on the same business in the recoupment year as it did just prior to the continuity of ownership test failing. Blocks can therefore recoup the tax loss from year 1 against its taxable income in year 2. There are 3 elements relating to company tax losses. Where deductions are greater than assessable income and any net exempt income, a company generally derives a tax loss for the tax year. However, some deductions are not allowed to create or increase a tax loss, and so must be added back. A synthesised tax loss can also arise when a company has excess non-refundable franking credit offsets that exceed tax payable in a tax year. Tax losses are carried forward to a future income year. To recoup losses, a company must satisfy either the continuity of ownership test or the same business test. These tests are designed to prevent trafficking in loss companies. The continuity of ownership test requires the same persons, whether as individuals or through interposed entities, to own the same shares that carry more than 50% of the voting and distribution rights throughout the ownership test period. For tax losses, the ownership test period is from the start of the loss year until the end of the recoupment year. Additional rules and exceptions apply in certain situations, and taxpayers must be aware of the anti-avoidance measures, which can deny certain schemes and arrangements to recoup tax losses. In addition, widely held companies and other eligible companies have a less stringent continuity of ownership test. Such companies need only have substantial continuity of ownership to recoup tax losses. The test times are generally at the end of each tax year, and the required tracing to identify ultimate ownership interests is also simplified. If the continuity of ownership test is satisfied, then the company can recoup the tax losses. The same business test operates if the ownership test is failed. The test time for the same business test is immediately prior to a failure of the continuity of ownership test. This means that it is not the business of the loss year that is tested, only the business carried on immediately prior to the change in ownership. In addition, the same business must be carried on at all times in the recoupment year. Further, no new business or transactions can contribute to assessable income or be commenced for the purpose of meeting the same business test. The same business test is a more subjective test than the continuity of ownership test, and so relies on case law to clarify and apply the principles. For example, the internal operations and production, as well as the end use of the products, should continue to be the same. If the same business test is satisfied, then the company can recoup the tax losses. Once the relevant loss recoupment tests have been satisfied, the company is able to apply carry-forward losses against taxable income. Tax losses first need to be applied against any net exempt income in the future tax year. The company then has a choice as to whether to apply the remaining tax losses. Companies will normally want to reduce taxable income and reduce tax payable, and will therefore apply tax losses immediately. However, if the company needs to pay additional income tax to make frank distributions to shareholders, they may elect to delay the utilisation of tax losses until a future tax year. Note that there are some rules about how prior year losses can be deducted, primarily that the oldest available losses must be utilised first. To recap, there are 3 key elements relating to company tax losses. First, we need to ensure the company tax loss is calculated correctly. Second, we need to be aware of the loss recoupment rules that are designed to prevent trafficking in loss companies. Lastly, we need to be aware of the options and restrictions on utilising available losses.